Okay, good morning all. Thursday, 11th of May. Just having a look at the charts this morning. Just as I'm speaking, S&P just having a little move to pivot. But overall, the chart's telling a story of not a great deal going on at this present point. Pretty flat overall. The currency pairs, unsurprising to see cable pretty unchanged on the session. Mainly consolidation in this kind of range of 129.40 up to what is now the daily pivot on the day at 29.65. As to be expected, Super Thursday, of course. That's going to really dominate the content of what we'll talk about in this briefing today. We'll go through that in more detail. Otherwise, euro-dollar marginally higher. We did have ECB's President Draghi speak yesterday. He didn't really say anything untoward that would make you want to change your view about anything near term from the ECB. But some of that weakness that was certainly apparent from the kind of, I guess, Macron-inspired profit-taking through that 110 handle seems to have dissipated at the moment, and for the time being, the gap higher from the first round of elections remains in play. We did see a low point down at around 0.873 yesterday, so that range still holding up from a slightly longer time frame. Dollar touch weaker, down about a tenth, but again, the chart's really reflective of not too much going on, and it's really reflective in the kind of overnight news, if you like. The one thing is, obviously I wasn't here yesterday afternoon, but I can see oil made a pretty decent recovery. I can see what I had marked up here from yesterday's briefing when we looked at the APIs, which were on the balance more bullish for prices, and really you can see how different the reaction in the marketplace is when North America is fully in the market, as to is UK and Europe, given the timings of that 3:30 PM London time release from the BoE inventories. Much larger move than what you'd get typically at 9:30 when the volumes are very low. Just for any of those who ever do look at oil when the APIs come out, essentially you can subscribe, so oil majors or firms, let's say oil related trading houses or funds, might basically subscribe and pay a fee to access the API report, which they get at 9:30. Official news wires don't release that immediately because of the distribution cost they would have to pay to the American Petroleum Institute. So major news wires don't tend to run it for about 3 to 5 minutes after. Twitter, sometimes it circulates a couple minutes after the release. But what tends to happen then is that unless you're one of those people who have access directly to that report, you're quite disadvantaged from an information flow point of view at that 9:30 API release in the evening on Tuesdays. And so hence as well, that probably lends its hand to why the reaction tends to be more muted comparative to what we had yesterday afternoon. Obviously timing is key, and the volume in the market is the bigger reason. But recapping those numbers, kind of saw them for the first time this morning, a drawdown of 5.247 million. Pretty sizable, similar case to what we had in the APIs then, probably some of the biggest drawdowns we've had at least since 2016. The surprising thing though, looking at these numbers, is it's with a multi-layered release like the crude inventories, what's interesting here is they're all kind of pointing in the same direction. By that I mean distillates was a fairly large draw, gasoline was a draw, Cushing a drawdown of nearly 500,000, refinery utilization was negative 1.8, but on a balance then, all pointing to a more cleaner move in the market. And this is kind of what you're looking for in a multifaceted release, is all of the components pointing in the same direction. And looking at this price action, pretty decent pop on the upside to the saviour, I would say, probably of a number of OPEC nations. Fortunately, the inventory situation, at least for the time being, has stopped the rot that was kind of materializing certainly at the end of last week. On Friday, if you remember, we got all the way down briefly to a sub 44 handle, and here we are now back just shy of 48. I guess looking forward, upside, just looking here now, You've got R1. You've obviously got the 48 handle, R1 sitting at 08, so just above. You've then kind of got that low point that was seen back at the end of March 27th, that was seen at 48.19. So a couple of levels of resistance on the upside technically. I guess now it depends on your fundamental view. I'd still say US output was up again yesterday. Fairly small size, but it continues that pattern that we've seen. So US by no means are backing off the pace of ramping up their production, which overall is a negative in terms of crude oil prices in the longer term, in this battle between the US, kind of Russia and OPEC, so to speak. One thing the oil move did create though was some support to the equity markets. Quite surprised that the market didn't see more negative connotations from the firing of Comey by Trump. I would have thought that might have brought about a few question marks on now Trump's ability on the timeline to deliver on the key fiscal reforms. However, market seems to have just looked beyond that. We've always talked about this before, is that the market seems to have priced in to a certain degree Trump's erraticness, so to speak. And so for the time being, we've looked beyond that, and the oil numbers certainly probably would have helped. You can see this move in the S&P here, because don't forget, probably last week when oil was under pressure, the energy sector, I would imagine, would have underperformed in the S&P, and so it's ripe for a bit of bottom picking, so to speak, in the short term, and likely the energy sector yesterday would have outperformed with that decent move higher, and consequently helping lift the index proportionately. In the grander scheme of things, obviously, this is still a pretty ranging market, not a great deal going on. So we're glued to pivot, at least for the time being. Let's take a look at the pound then. Let's talk Bank of England. Super Thursday doesn't come around too often, and so let's have a look at the structure of what Super Thursday is for a start. So let me just flip over to some slides that my colleague Philippe has put together. And this is looking at, first of all, the structure of the Bank of England. One of the main things here to have a look at is how many basically meetings that they have per year. So they meet 8 times per year. And what is critical about today is that today is one of the 4 meetings of the 8 during the year quarterly. We get what's called the QIR. You probably hear that referred to in financial press. It's the quarterly inflation report. Now, alongside the new structuring of the way the Bank of England now delivers, the reason why this is called Super Thursday is not only do we get the announcement on interest rates, quantitative easing, or the asset purchase facility, APF as it's known in the UK, you also get the vote split, you also get the quarterly inflation report today, and you also get the minutes of their discussion from the 3-day meeting that they've had to make the decision which they'll announce at midday today. So it's a multi-pronged event, which means that like any time you're trading a fundamental event that has many different scenarios, it can be quite a tricky affair. The one important thing here is then eradicating what is it that the market is already priced in, and therefore you can reduce, if you like, the number of components in this release to make it a little bit more clearer on what exactly to focus on in order to trade the event. Now, saying that, no one is expecting any change in interest rates. So that's not what the people or traders in the market are looking at today. No one is expecting either any changes on QE. So if those 2 particular variables, you can move those aside. They definitely will not be changing those today. That, though, brings about another question, is the vote split. Now, the vote split could be interesting. Back to Philippe's slides. He's quite nicely put together here on the kind of left-hand side, on the axis, the kind of gravity of the person's position, and then on the axis left to right, how dovish to hawkish that individual is. Now, the interesting thing here is that, well, for one, you'll notice that there's only 8 MPC members. There typically is 9. But if you remember Charlotte Hogg, I think she lasted the grand sum of about a week in her position on the Monetary Policy Committee before she failed to unveil the fact that I think it was her brother was a senior trader at Barclays, and so she resigned. She had to go under kind of political pressure. That means there's only 8 people we're looking at today. Now, what this means and what we're looking for is Christine Forbes previously has voted for an interest rate hike. Now, from a trading event, this is important. For longer term, what it means to the Bank of England is actually probably less important. That's because Christine Forbes is due to finish in her term in the summer. But what some people are looking at is this chap on the bottom right hand corner. So these are obviously the 3 cluster of more hawkish people. You've got Kristen, Ian McCafferty and Michael Saunders, who actually out of all of them is the newest person to join this committee. Now, Michael Saunders is one on which the press are locking onto because he made the case for higher interest rates in a speech to the Federation of Small Businesses in London at the end of last month. So it was only about 15 days ago he made that speech, and he was talking about higher interest rates. That's meant that some people are of the belief today that the vote split could be 6-2, which, if it was 6-2, would be the first time that it's gone that hawkish in the vote split since basically 2014. You know, we've not been that close to being anywhere near raising rates. This, of course, is probably down to the fact that these hawkish members are focusing on the threat of higher inflation, chiefly down to the sharp depreciation of our currency and those price pressures that have been building from imported inflation. Now, one thing I would say about this view that Michael Saunders, the chap here, could be hawkish today was that he himself, in the same speech, did say that the hawkish tilt to his outlook was not a hint or a code that he was about to back a rate rise. So I think that the press, personally, I think they're getting a little ahead of themselves in forecasting that he's going to flip into the hawkish camp. I actually don't think that's going to occur, and I think that the split will be 7-1. I think probably that's on balance what the general market consensus will be. That meaning then, if you did see a 6-2 split, likelihood you'd probably see a pretty aggressive knee-jerk reaction higher in cable on its first instance. Let's have a look at the kind of macro picture UK-wise, and it will give you a bit more information about what else to look at, because we also get the minutes where we'll hear the conversations on how the various MPC members are assessing economic conditions and therefore net their future expectations. And then interestingly, we'll get the quarterly inflation report, and what's critical from that is the Bank of England's GDP and, more importantly, inflation forecast over the 2-year horizon. If you know those 2 pieces of information, it gives the market the ability then to forecast where interest rates will need to be in order to manage those forecasting measures going forward. Now, a couple of charts here. First one up, UK economy grew the least in a year in the first quarter. Now, one caveat to this is that there is seemingly a seasonality or seasonal effect with these numbers. If you look at Q1 2017, Q1 2016, Q1 2015, the last kind of 3 measures or 3 years have all been reflective of initial slow growth, only then to recover. And so probably people won't read too much into this, but one thing is obviously we're going into a period of heightened political uncertainty. Not only do we have to negotiate now the situation of Brexit and the EU in trade talks and so forth, transitional deals, we also have, of course, the 8th of June when we'll have a general election. I would suggest then that apart from Christine Forbes, who once someone flips to the hawkish and votes as what's called a dissenter, very rarely do they then step back in line. You can imagine what that would do for your credibility at that point. So they tend to be quite steadfast when they move, that they stay of that view. So I don't think she's gonna change. But for these reasons, mainly on the political spectrum being so uncertain, I would suggest that the majority will see absolutely no need to sound too hawkish at this point. I actually think this is more of a holding pattern, if you like, for that clarity to materialize. Other things we're looking at here: workers getting squeezed by faster inflation. If you look at the savings rate at the moment, because of the fact that the price of goods is going up, but real earnings growth is basically flatlining, what that means then is that people's savings rates are absolutely plummeting at this present point. Household incomes then getting squeezed. So a lesser reason then to start hiking rates. Some Bank of England officials fear there's little slack left. So this is looking at the unemployment rate. Now the unemployment rate has been particularly low for a long period of time. Unemployment not so much really a focus, I'd say, of the UK economy from a policy setting point of view. Steady as she goes, the pound has levelled off since the Bank of England's last forecasts. Now this is actually quite important, because the fact that the pound has recovered back up to really this 130 type level, at least in cable futures, which is the top end of the kind of more recent range, is that actually then this starts to negate some of the need for the Bank of England to be as aggressive in hiking interest rates to get ahead of the curve to negate impending inflation. If sterling was still down at 120 or lower, then certainly this would be a completely different situation. But all the more reason again for the Bank of England to kind of to sit on their hands, so to speak, this time round. Probability of the Bank of England hike by the end of this year meeting is lower than it was 3 months ago. So actually, if we're looking at, well, this is a rate increase by the end of 2017. So looking at the white line, this is the fluctuations in the market's perspective on how that they see the Bank of England's probability percentage-wise of increasing rates. And if you look where we are at the moment, the market's priced in by the end of the year a chance of a rate hike just over 20%. If you look at where we were in February, we were up at 50%. Probably, I'd imagine, if I bring up the UK CPI chart, if you give me one moment. So this makes sense then. If you look at the actual statistics, look at the jump that we had from January of 2017, 1.8% year on year CPI was tracking. We then had statistically what is the biggest jump that you can see dating back throughout this entire 12-month period. Inflation in the UK went from 1.8 to 2.3. This is when the market had really big concerns about rampant inflation that would have to be countered by rising interest rates. Hence then, when you look back at this, why here this number was so high. What you can see here is a dramatic collapse in those expectations. Now why did that happen? We leveled out. Actually, what some people might have feared is that we would have gone to 1.8 to 2.3 to 2.6 to 3% in pretty quick fashion, much quicker than the Bank of England expected, but that didn't happen. What that meant then is the market has repriced its expectations at one point all the way below 10% from what was 50 in the space of just 1 month. It's then crept up slightly more, but into the period where we are at the moment, I would say the pound has been recovering. Obviously the pound has actually increased since Theresa May called the general election. This whole idea about having a stronger mandate, a much larger majority in the lower house of Parliament gives her greater flexibility to negotiate Brexit, meant that the pound has been supported, and hence we're at the higher end of recent ranges at 130, and as such then expectations are fairly tame that the Bank of England will need to take any action. Okay, so that's kind of like your overview of the situation. In essence then, I actually think Super Thursday overall is going to be largely not that big a deal, because quite frankly I don't think there's any need for the Bank of England to do too much at this point. Certainly not with fairly benign growth in the first quarter and also various levels of political uncertainty at this present point. And so upside, certainly you've got pivot near term, but then this recent range in 130, that's really the bigger levels to be on the watch for on the upside. How could we get up there? Well, if Michael Saunders flips to Christine Forbes and is joined by Ian McCafferty, for example, and we go from 6.2 to 5.3, definitely 130 would be tested, I would imagine, in that setup. If as also that's followed by hawkish comments, particular focus on inflation, and if they see that going higher, that would also bring about a test of those levels. But quite honestly, I think that that's not going to materialize. So despite the volatility, I don't really see cables seeing a great deal of movement, and I'd be more kind of looking at this low point that we printed at the beginning of the week, defining the downside. So if we were to break S1, and then yesterday's high that we had in the morning around that 130 is probably the range I'd be looking at during the actual release. Don't forget, the final piece of the puzzle will be Mark Carney will be holding a press conference, and just like when you're trading and monitoring ECB's Draghi in the regular press conference, there's kind of two ways to tackle it, and that is anything important that he really needs to say, he'll say it fairly early on, and Q&As, the most pertinent questions tend to come first. The longer the press conference goes on, it can last up to 45 minutes. The longer it goes on, the less likely there'll be a market moving comment towards the end. Typically it's quite front loaded. So we'll be watching that, and I'll be providing you with live links at the time. Just as I've been talking, I have seen oil moving the corner of my eye, so just quickly bringing that back into shot. We've had a quick run up then to this 48 level, so still adding to the kind of bullish sentiment on the inventory front occurring from yesterday. So as I was saying, you've got that 48, R1, 08, and then 19, that previous low on the 27th. I'll just be keeping an eye on. Okay, just to wrap up, calendar. You do have, preceding the Bank of England event, you do have UK data. You've got trade balance, manufacturing industrial production for the month of March, and construction output. Quite a few different things coming out here. Now, what would happen normally is that this could potentially be quite market moving for sterling currency. However, given the fact that the bigger market event is the fact that this isn't just a standard Bank of England decision, this is the quarterly inflation report month, means that I doubt many people are going to want to commit into any type of trade around these figures when they're waiting, saving ammunition for the bigger event, which will likelihood create a much bigger market movement. My advice then is that this 930 data, I wouldn't jump in unless something particularly unusual happens, i.e. a number far-reaching out of line that might cause a fast money move. If you enter a trade, I think you need to be pretty aggressive in and out quite quickly, because the market, I don't think it's going to have any type of sustainable trend, not until the bigger event occurs at 12 o'clock and the press conference follows. Looking at this afternoon, weekly jobless as per every Thursday from the US, PPI numbers. We've also got a couple of speakers to be aware of. Fed Dudley, 11:25, speaking on globalization. Dudley, a voter, more senior member as well on the Fed, so worth listening to. And then that pretty much wraps up the morning and the day. So Bank of England a real focus. There's been a couple of corporate earnings as well, just to give you the percentage inclines. UniCredit up 4%, Credit Agricole up 2.5%, Deutsche Post though down 3.5%. So a bit of a mixed bag, but some of the bank stocks faring fairly well under those earnings reports. Okay guys, going to leave it at that. Have a good day. Any questions, feel free to pop them in the chat.